And we are live. Hello, everybody. Thanks so much for tuning in. It is May 2 for a long weekend. We hope that everybody's having a safe but well-rested weekend.
Yes. Hopefully everyone took some time to get outside. It was pretty nice out. Nice little change.
It was gorgeous. The weather's definitely turning to what we want. We're just gonna wait for a few people to come on here, and then we had a post that we released yesterday that outlined the 20,000 down flip product. We have spoken about this a handful of times. We've created a few videos on it, but a lot of our clients have had a lot of success with the product. And our audience has grown significantly over the last little bit. So we're going to wait till everybody gets on here. We're expecting quite a few people on today through all of our platforms. We're going to break down how this $20,000 flip product works, the positives, the advantages and disadvantages, some other products in the market that work really great if you're looking to reduce your overall cost. There's a handful of really cool products that our clients are using right now with high degree of success.
Yeah, there's other options out there for those lenders or for the borrowers, who can afford to put that 20-25% down. So we want to touch on some of those products, just some other options out there. Some amortized portions help you pay down a little bit of that principal as you're moving throughout. Also just better interest rates. The flip product obviously has a little bit higher leverage, so interest rates are a little bit higher. So what other options are there out there if you like I said, you have the down payment and you want to save a little bit on the bottom line? So we're gonna touch on that.
For sure. I think we're just waiting for a few more people to get on here. But again, if you guys have any questions about anything that we talk about, this is your time to be able to connect with us. And we're happy to answer them as you have them. We find that a lot of these seminars or a lot of these one-on-one lives that we have with people, it allows us to take a look at some specific questions and help people with something that they might not just want to take the time out of the day to give us a call for. So if you do have any questions, give us a shout.
Yeah. I think probably jump into it.
Yeah. Well, let's get right into it.
Yeah. All right. So let's just we'll start right on the 20K product. So like Josh said, we've touched on this a few times, but we'll go over the full details again for anyone who hasn't heard of it. So for those who are looking to complete burrs and flips, and the barrier to access is that capital requirement up front. We have this product where for purchases of $350,000 to that $800,000 area, you are able to put as low as $20,000 down as a down payment. So really reducing that capital cost to get in. There are some fees involved. We'll talk about some of the costs. They're bundled into the mortgage as well too. So it's a 2% fee of the loan amount that's bundled into the mortgage, paid out on the back end. Again, mitigating just some of the costs upfront needed to be able to move forward the transaction. It's a short timeline, so we're looking at a 6-month term. It is fully open, so there is no exit penalty to get out, no interest, no interest rate differential. It's zero cost to exit out. In terms of penalty wise, there are discharge fees, of course, for every mortgage, but in terms of exit penalties, there isn't any. These guys don't necessarily take a look at the value based on from an appraisal. They want to see comparables, sold comparables. So we want to see a minimum of 3. If you can get an old MLS listing with the pictures from the properties, that is usually the best option. We've seen like House Sigma and some of these other sites as well too, that again, as long as it's sold and it shows the value and it's pretty similar to the property you're looking at, it'll work for us and it'll work for the lender. One of
the great things about this product specifically that I love and that a lot of my clients love is the flexibility that it offers. You take a look at all the different types of capital in the market, and when you try to do a flip, as Aaron said, it's decently capital intensive. The majority of our clients who are looking to get into this either don't have that much capital or don't want to allocate that much capital to have it being dead capital. So if you are conventionally doing a flip or a burr and you are going to need your 20% down, you put it in the project, and depending on the average cost of a home, it's roughly around $80,000 to $100,000, and that can be a lot for a lot of investors who are just looking to enter the market. So this gives you leverage, but in return, it has higher rate. So So this is something that we go through, that we discuss, your overall risk tolerance for a product. This product necessarily isn't for everybody. It does have a high carrying cost. So it's really important that you work with us to dial in a few things. One being the overall reno budget. What are you going to do to the property? And do you have the ability to actually do the renovations? Capital. So do you have the capital available to do it? Savings, credit card, cash, line of credit. You just have to show us you have the capacity to do it. And exit strategy. So how are you going to BRRRR it? If you are going to BRRRR it, the most important thing is, can you qualify for the loan after it's renovated? Due to the high carrying cost in this product, really important to have that exit strategy defined. And you might be possibly starting that refinance, a day or two after you take over the property, because that refinance process might take a month and a half. And if your construction is going to take you a month, you don't want to be starting your refinance after, especially because the carrying cost is so significant depending on how much loan you have.
Yeah, and obviously because it's private, they're quite flexible on the down payment solutions as well too. So a couple examples: if you only have funds for the renovations and you're a little tight on the down payment funds, or you have the down payment, don't have the renovation funds, they are able to collateralize additional property. So if you need to borrow funds to cover both the down payment and the renovations, as long as you have equity, ideally in your additional property up to about 75%, that they would want to see. That's kind of best case. We can tag that secondary property, we can use the equity, and we can increase your loan amount to cover the down payment and the renovation costs, like I said, as long as there is enough equity available. Another thing that they're able to do are these shorter term bridge loans. So if you are completing a flip and you're looking to close on another property, you found a good one, it's popping up before your sales date. If you have a firm sale agreement on your other flip that you're looking to sell, they can take that property, essentially give you a bridge loan to get in. And then once you finish that sale, they'll just take some of the proceeds out and put that right towards the down payment. So, I've had a couple of clients that were in that situation, and they're more than happy to get that done. So, they're pretty flexible in what we can do and what we can use. And, if you have funds coming available, but not quite at the time of purchase, talk to us, let us know. And there are some solutions to be able to get around that and still get you into the project and be able to get it completed. Yeah.
So when it comes to the lender specifically, this is a mortgage investment corporation. So this is a federally regulated financial institution. It's regulated by, it's provincially regulated in certain parts, but Ontario specifically has not ownership, but oversight over the mortgage investment corporations. This corporation's been in business for about 40 years. They have access to capital and enough capital to be able to offer consistent products to the market. So mom and pop lenders are great to have. They're really flexible, but this lender specifically has a ton of capital and is able to help us structure these loans for a handful variety of places. Because when you take a look at a lender or a product that's going to work best for you, you want to find one that's not 100% area specific. So mom and pop lenders, they might just lend in Kitchener-Waterloo or just lend in Toronto, depending on where they really know. Whereas if you work with larger institutional lenders, they may have a larger scope and be able to help you with more flexible solutions, possibly in cottage country or something like that.
Yeah, we've done some cottage flips with them. Cottages are obviously super popular right now. We've had quite a few done, actually, just making sure that the comparables are there, and make sure it's similar. If you have a cottage that isn't on the water, don't use on the water comps. It's just not going to create the value needed. They just aren't similar enough. And then just like a quick topic while we're on the cottages, just making sure that it is, or just understanding whether the product or the property is a type A or a type B cottage. There is a big difference in between. If you're looking to actually, BRRRR that property out and you get in on a type B, it definitely changes your financing if you haven't converted that property in to a type A. And then on the flip side, if you're looking to get that conventional financing, it can be a great product to get in, get a high loan to value on potentially, what is usually 65% loan to value on a type B product. As long as those comps are there, or if you have some additional collateral, get in at, hey, 20K or minimum down payment, like I said, to bear that 35%, get it converted over to the A side, like a type A cottage. And then we can refinance back out with a Schedule A or a Schedule B lender at a much better loan to value and rate than what you would have got with a 60 or with a type B cottage.
For sure. So one of the most important things, and we're going to get to it right now, I just saw it in the chat here, is rate. So This comes with a decently flexible rate. So if you wanted to put $20,000 down, the rate is 15.5% annualized. Now that is over 12 months. This is a 6-month open term. So roughly is about 1.3% per month if you're looking to be completely leveraged. Now this is a scaling rate. So as you increase your down payment, the rate decreases. There are minimum down payment requirements depending on the total value of the property. So you can't have like $20,000 down for like $150,000 property. They do have minimum requirements for the overall down payments if you wanted to scale to a lower rate. Most of the people who take this product, most of our clients who find success with this product, specifically use it for about 3 months. I'd say about 80% of my clients are in it for about 3 months. That's enough time to be able to get in, execute your strategy, and either sell or refinance out of it. I find the majority of the people who are using this product effectively are using it multiple times consecutively, whether that's being in multiple projects at the same time or just bouncing profits from one to another to another to another. There is a lot of success with it. Obviously, understanding your risk tolerance and your total leverage is very important. We are currently in a market right now that is stable-ish. I mean, the appreciation on assets over the last 6 months have been significant. It's important to understand where we're at in the market when looking at high leverage products, and especially dialing your overall exit plan, because at the end of the day, the most important thing here is profit for the lender and for yourself. And we just want to make sure that you are going to be in a situation to be able to profit from your project.
Yeah. And Josh nailed it. This product is specifically geared towards people who are looking to do a high volume of flips within tight timelines, being able to use equity from projects. Like I said, if you have a flip that you completed, it's on the market, you got a firm sales agreement, we can use that proceeds and that equity before you've even sold the property to get you into your next flip. That's what they're looking for. And they want to work with these high volume flippers who are experienced, but they also want to help these newer investors and new flippers, get into the market and get moving forward as well too. They're one of the only lenders who really do some sort of pre-approval on a private product as well too. We have an application that we can get filled out. We'll collect your documents. We'll take a look at everything. We'll get you set up with the lender. They'll give you a phone call. They'll ask you about what your experience is. What are you looking to do moving forward? Do you have a coach that you're working with? If you don't have any experience, who's doing the renovations? They'll make sure you have a full understanding. They'll have a full understanding of what you're looking to do move forward, and they're going to let you know where your limit is based off the details, and you're good to go. And they only do that pre-approval and that approval once per year. So once you've been pre-approved, you've given them their details, and they've given you the okay, you don't have to go through that approval process again. Now, caveat that with, if you're bringing on someone new for your next project, they are going to want to get some details from your other partner. But if it's just yourself and you've already been pre-approved, there is no need for documents and stuff. You're good to go for the entire year. They'll pre-approve you once again at the start of the next year, and then you're good to go for that year as well too. So once a year on the approvals and streamlines the process, make sure that you can get in and out quick and easy.
Something to keep in mind is this product is not available across Canada. Currently, it is available in Alberta and in Ontario. So if you guys are investing in Alberta or Ontario, this is a phenomenal product for you. I know they are working on some top secret products that are going to be coming out decently soon. It's going to add a lot of flexibility to our investors, especially ones who are able to scale and who want to use this product to scale. We're really excited to tell you about it. We just can't yet, but it's coming. When it comes to these type of products, sometimes the interest rate can be a little bit higher than people might feel comfortable with, which we completely get. High leverage isn't for everybody. So there are other products in the market that you may consider other than this product, if this one specifically isn't for you. Now, one of the ones we wanted to talk about that we just actually made a video on, it's going to be releasing in a few weeks, is about the declared income product. First National is releasing it or has released it. It's a phenomenal product for people who make a bunch of money, but don't necessarily show it on paper. Do you want to explain it?
Yeah. So the declared income, like Josh said, is simply just a declared stated form. There is no proof of income required. So it's, just a declaration with signature of verification. There is no TDS and GDS requirement either. So there is no personal debt servicing. They aren't looking at how much income you're making versus how much debt you have. Simply just what you state. The loan to value itself on the first position goes up to 65% loan to value, but they do allow you to have a second up to 85% behind them. So this is a alternate product offered by First Nat. So you aren't getting a 1.5% rate. You're in and around the 6.5%, but it is an amortized rate with a national lender. So instead of going with a private lender potentially and having higher fees, higher overall costs associated with it, this product allows you to get in with the amortized first at a bank, put a second mortgage in behind if you need, whether that's an actual second, whether that's a vendor take back, to get in and get it done with just putting 15% in potentially on the deal. And no personal debt servicing. So it's a great product. I think there's going to be some creative ways to be able to utilize that product and help some people get in. Especially if you're in between. Maybe for a lot of the guys out there, you guys just started becoming investors. You just started having money in a company. You don't quite have 2 years. You're not able to show anything on paper. This could be a great alternative type product than a full private mortgage in some situations.
Yeah, just touching back on some of the questions that just came up on our live. Our holdco is available. Yes, you can use a holding corporation through that $20,000 down product. If it is a new corporation, all I need is the articles of incorporation and the shareholder registries. If it is not a new corporation and you've had it for longer than a year, they just require that you give us proof that there is no taxes owing through your corporation and your notice of assessment. One of the other questions is what kind of documents do we require? So our online application, the fillable application, and a notice of assessment is going to be what we need for the pre-approval. And then when it comes to verification documents for your deal, we need 3 to 6 comps sold in the area to verify your ARV value. So what we do is, or what our lender does is, they will take all of your comps, they will take a look at your total construction budget, and then they will take a look at your purchase price. They'll find the purchase price, they'll say, okay, these are the renovations you want to complete, and then they'll take a look at your comps and say, okay, well, Sally says her ARV is going to be $850,000. Here's 6 comps with the same finishes in the same area, the same square footage that can verify that is the ARV they're going to get. And then once the valuation is complete, they will issue a commitment based off that. Something to keep in mind is the loan amount cannot be more than 80% of the ARV value. So if there isn't enough profit in the deal, unfortunately, it doesn't work. So the main goal here is for you to make money, and obviously for the lender to make money. They are here to facilitate that transaction for you. Yeah,
and they want that buffer in there because it allows an easier exit for you to get out of the product. When you have that 20% difference in there, you're already at an 80% loan to value where you should be based on the ARV. So they're really helping you out in leaving that equity in there to make it a lot easier for you to move forward and have that built-in equity. They don't want people stuck in their loans. These guys aren't sharks. They're not here to take properties and go power sale. That's a lot of paperwork. It's a lot of legal costs. That's not their business. They're here to help guys get in and out as quick as possible and as easy as possible. So that they have that there for a reason. If they ask you to put, an increased down payment down, it's because it doesn't fit their risk. If you want to keep that down payment as cheap as possible and they're asking for increase, give us some equity, give us another property, let us collateralize it, and we can get it done that way. Yeah, and move forward.
One of the cool things, or one of the case studies I wanted to run through with you guys, is a client I'm working with right now. They are purchasing a property and they want to do some renovations on it. They have the money for the renos, but they don't really want the high carrying cost of 15.5% because they're not sure that they're going to be able to get it done within like the 2 or 3 months. It's probably going to be more like the 4 or 5 month area. And that carrying cost is significant due to the loan amount that they're getting. So one of them was able to come up with a property that they had. It's a rental property. There's about $150,000 in equity in it. What he did was he said, here's my property. It's worth $350,000. I got about 100 on it roughly. So we use 75% of the value of that property. To be able to use that property, we need to verify the value of it. Now, most private lenders would require an appraisal on the property. This lender that we work with allows us to be able to use comps the same way we would with your subject property. We'll verify that value, and then we can use the equity in that property as a down payment source. So we were able to use 25% or the 25% down payment that my clients would have had to put down to reduce the rate to where they wanted out of that piece of equity. and the total loan amount was increased to that amount, which would then allow my client to have a low carrying cost, feel comfortable with their overall monthly payments, and we're able to, get that project complete. So if you aren't comfortable with the leverage, we can do this with any one of our lenders, but it's really good to know that the openness of this loan and the term that they allow most of our borrowers to have, this specific solution allows a lot of our clients to be able to execute effectively without having to take on that overall cost and decrease their bottom line.
Yeah, and again, if you guys aren't necessarily looking to just increase your down payment and you want to put that minimum 20K down, and you can, if you have additional property, you can just collateralize it to keep the rate lower as well too. You don't have to increase the loan amount. It effectively decreases the loan to value to the lender, so they're able to use that lower pricing with that minimal down payment. So we have lots of options. Just let us know kind of what you want out of the deal, and that's why we really have that initial consultation. What other properties are available? What are your goals? What are your needs? And then we're able to kind of create the mortgage from there and make sure it's tailor made to you. Speaking of just other lenders out there, there are other products on the B side as well too, where if you have 25% down that you want available that you want to put down, and plus some renovation costs, we have the ability to do a 4.5% fully open mortgage on the B side as well too. So much lower cost in terms of carrying, minimal exit penalties. Again, with it being fully open, there is no interest penalty to get out of it early. It is fully open. You're just paying your discharge fees. So another option for those who, again, maybe can't qualify on the A side, or, there aren't too many fully open products on the A side, if there are currently at all right now. Having that available to get in there at 4.5% nonetheless, which is pretty good. Much better than some of the carrying costs you're going to get on the private side. So if you have those increased funds and you have the capital available, we do have other products to get you in that are fully open to keep the cost down a little bit and put some more money back in your pocket at the end of the project.
Yeah, we are seeing, I'd say the majority of people are using it as a flip product. If you are looking to use this product to execute on a BRRRR, as I said previously, refinances are taking a significant amount of time, a lot longer than previous years, specifically just due to the volume that lenders are having at the moment. It is important to be able to plan out how long that's going to take and build that into your exit strategy and have that communication with your broker. So if you are in a situation where you do need to refinance, start it at an appropriate time. So when it does come time, you're not paying, that $4,000, $5,000 a month payment. You might pay one or two more of those payments if you aren't on top of where your refinance is and timing that correctly.
Yeah, gone are the current times. You're not going to get that 1 month turnaround on refinances. You're probably looking closer to a month and a half to be safe. Just refinances are kind of getting pushed, and lenders are trying to prioritize purchases as best they can, because even on the purchase side, it's pretty busy and they're backlogged, so they're just trying to keep up with the market. Refinances are definitely taking much longer than what we would like.
I would say, one of the last things we wanted to touch on for flips and BRRRRs, because this is a private product, there are a handful of other private products we wanted to touch on in the market. So mortgage investment corporations specifically tailor private products to the market. And we just spoke about one, but there are a few others in Ontario that we want to touch on. One of them being, there's one in Toronto. Now, they're able to offer low carrying costs but high fees. You have to look at the overall APR and what is your annualized percentage rate over the year. Now, there are a handful of things that might be important to you that aren't important to somebody else. One of them being carrying costs. So if you want a low carrying cost and a 4.5% carrying cost, that exists with private money. It can go 75 or 80% loan to value. Now, you're going to bite the bullet, unfortunately, on the fee to get in. So these mortgage investment corporations charge, usually they scale it based off of your credit score and loan to value, but it's usually between 1.75 at the most aggressive to like 2.5%, 3%. So the effective APR on the lender side is usually around 8%, depending on your total credit score. But those low carrying cost private loans do exist in the market. Usually people who have equity in a property, so somebody who's looking to refinance for a lower carrying cost would take that product. It's not necessarily as advantageous for somebody who is looking to purchase a product with it, just because you're going to need your 20% down, and then you're going to have to pay your 3% fee to them. So it can be decently expensive, but there are low carrying cost products in the market that you should be aware of. And if it's something you are looking to use maybe as an exit strategy for a year or a short period of time after a flip or a burr, it is a product that's available in the market.
Yeah, it really just depends what your goals are. Are you looking to maximize, the amount of capital you have? And if so, that lower cost to entry type mortgage is definitely going to be your best bet. It's going to allow you to get much more or much more projects done at the same time moving forward, keeping those costs minimum and just paying a slightly higher carrying cost than, putting 20-25% down on each. You're going to save a little bit of money on the bottom line, but in terms of being able to do the multiple projects at once, keeping that cost to entry at the minimum is definitely going to be your best bet moving forward.
For sure. Really appreciate everybody coming on here, especially during the long weekends. I think that kind of wraps up our 20,000 down product. We did want to touch on a handful of different types of capital. Now, if any of you have any questions in specific to your situation or the lenders or lenders or products that we spoke about today, please just reach out to us. We are working tomorrow, so give us a call. Our numbers are in the description below or on our website. Again, for everybody who came and streamed with us today, really appreciate all of you, and we are looking forward to seeing you all next week.
Yeah, and remember, you can get pre-approved for the flip. So if you want to get pre-approved, let us know. We'll get the application for you. We'll get a phone call set up, and we'll make sure you're ready to go.
All right, thanks, guys. Take care.
See ya.